We can also apply present value or future value of annuity in the financial reporting for the pension obligations. In the next semester, Intermediate Accounting 2, you will be introduced the topic of pension, a defined contribution, a defined benefits plans. So here I just use this simple example as a valuation of pension obligations or a liability. So on January 1st, 2024, at the beginning of 2024, this company hired a new manager. She is expected to work for 25 years until December 31st, 2048. Then she retires. After retirement, she is going to receive the pension for 20 years. So after retirement, the 20 years pension benefits is for this employee, but this represents the shoe company's obligations. The first benefits will be paid by the end of 2049. And the benefits to be earned or to be received by this employee will be $2,000 per year. And the benefits is paid at the end of each year. This company should contribute cash to this pension fund that will accumulate to an amount sufficient to pay for these benefits. Interest rate 6%. Question is, how much would the company have to contribute at the end of 2024 to pay for these pension benefits? To be more realistic, we use this chart. She was hired at the beginning of 2024 and retires by the end of 2048. So this is 2048. She retires here. But her first benefits received by the end of 2049. 2,000 each year for 20 years. Because the benefits was paid by the end of each year from 2049 to 2068. This basically was an ordinary annuity starting at the beginning of 2049 or ending of 2048. The question asks what amount of cash the company contribute at the ending of 2024 in the year when she was hired. So first, we calculate the present value of this annuity at the beginning of 2049 or at the end of 2048. Just using the payments multiply the present value factor of an ordinary annuity determined by 20 periods, interest rate 6%. So this represents the present value of this annuity. The present here is at the beginning of 2049 or at the ending 2048. But our purpose is not to calculate the value at beginning of 2049 or at the ending 2048. What we need to calculate how much the company contributed at the end of 2024. Just what it described. The present value of these benefits is actually the value at the end of 2048 or at the beginning of 2049. Value was 22,940. To the beginning of this appointment, this value is actually the future value. And next is we just calculate the present value of this cash flow to the end of 2024. And the number of years, 24 years, interest again 60%. So the present value of this single amount of cash was 0.24698. Then we get the amount, That's the contribution by the shoe company made at the end of 2024. Yeah, basically, this problem is a deferred annuity.